Let's take a look at an example of devaluation with the Turkish lira. Turkey is always an interesting country to study from a currency perspective because they have a lot of unusual dynamics about their economy. And that leads to big fluctuations in inflation and currency values. For one, they rely a lot on portfolio investment, and that means that a lot of the capital inflows that go into Turkey are in this form of capital, and that tends to be quick money. And so that money goes into stocks and bonds in the country of Turkey, but because it can come in quickly, it can just as easily come out. And so that's generally good that Turkey is getting investment into the country because that enables economic growth. But the thing about portfolio investment is because it can move in and out so quickly, when conditions wither or there's a downturn for Turkey, then that portfolio investment can be withdrawn pretty quickly. And that capital flight can lead to a depreciating value for the country's currency, the Turkish lira. And that causes all kind of painful effects, especially for those companies in Turkey that have established themselves by issuing foreign currency bonds. And so they still have to pay. Remember, there's a lot of portfolio investment in here coming into the country. Some of that takes place in the form of bonds. And many of those bonds, especially in emerging market countries, are issued in foreign currencies like the dollar or the euro or the yen. So when the currency, the lira, depreciates, then the debt of those companies that have issued foreign currency debt balloon in terms of lira values. So this is a problem. If they generate all of their revenue in lira, or at least a substantial portion of it, then it's just going to require a whole lot more revenue to make good on those bonds, those foreign currency bonds. So this is kind of the epitome of a foreign currency crisis, and Turkey is always perpetually vulnerable to it because its reliance on portfolio investment. And another interesting thing about Turkey, at least as of in recent years, there's been a single president and debatably democratically elected with unorthodox monetary policy. So his belief is that you should keep interest rates low, which, by itself is nothing spectacular, but one of the consequences of keeping interest rates low for a very long time for Turkey is the production of a bubble in the stock and housing markets. But perhaps more painfully, is the inflation rate, which as of right now is about 50% per year. And some of this effect is from a weakening currency. When your currency is really weak, anything that you import that's in foreign currency gets more expensive. So some of that inflation is being driven by that. And as we're learning right now, part of the reason is that when your interest rates are really low relative to other countries, investors tend to chase after investments in countries where interest rates are higher, where they can get a higher yield. So this results in a depreciating currency where interest rates are low. Now, Turkey tries to kind of counteract some of that depreciating currency by use of foreign currency reserves, as we talked about before, holding reserves of other countries' currencies to buy back its own currency to push up the value. But there's a limit to the amount of stockpiling that they can do of other countries' currencies. So there's a limit to the amount of intervention that they can engage in to influence or stabilize the Turkish lira. And that's just kind of the current state that Turkey is in. I encourage you to read more about it if you're interested. But it used to be that things were a little bit more stable there in terms of currency values. At least in the sense that they had a semi-fixed exchange rate. And so this brings us to our exercise here, a mathematical exercise of how to calculate percentage devaluations for a currency. So devaluation is when you have a country that manages their currency within a fixed kind of range, as opposed to a depreciation where that is influenced, the weakening of the currency is just influenced by market forces, by people buying and selling, and that act of buying and selling determines the value. Devaluation means that, okay, the country had kept their exchange rate within that fixed band, and for whatever reason, they couldn't manage it anymore. Maybe their reserves weren't high enough. And so they had to break that fixed exchange rate to a different level. It's still fixed. It's just that the ratio of that currency in exchange for another gets changed. So that's a devaluation. They are rare enough. But if you're going to calculate the change in a currency before and after the devaluation, you can use this formula. It's the spot rate prior to devaluation divided by 1 plus the devaluation percentage. So this is going to be a negative number. And then just that is going to equal the spot rate after devaluation. So let's say it's February 20th, 2001. And right now, the fixed exchange rate is 72,000 Turkish lira to the dollar. By the way, if you look at the Turkish lira now, it's like 30 to the dollar. But this is sort of a different type of Turkish lira that's trading now rather than 20 years ago. The kind of the ratio was very different than it is now. But back then it was fixed. And overnight, Turkish government announces a devaluation of 20%. What this means is the rate at which you can trade foreign currency for lira becomes weaker. The lira becomes worth less. And to know how much less that 20% is, we can just substitute the numbers that we've got in here. The spot rate on February 20th, 2001, prior to the devaluation, was 72,000 lira to the dollar. The devaluation announced was to be a 20% devaluation relative to February 20th rates. So a reduction of 20%. And then 1 plus that minus 20% is just going to be 80% or 0.08. 0.8. And when we do that calculation, what we get is the spot rate. Now, let's suppose that later the Turkish lira was devalued further to 106,000 lira to the dollar. This time, let's kind of work backward and see, like, what is the percentage devaluation going from 90,000 to this 106,000. And if we have two exchange rate levels and we're trying to find the percentage change instead of vice versa, what we can do is, if we're looking at it in terms of liras per dollar, like the currency we're interested in divided by the dollar, we can take that beginning exchange rate, subtract out the ending exchange rate and divide by it, and then multiply by 100 to get our percentage change. So we were talking about that 90,000 devaluation, sorry. We're talking about devaluation here because it's the government that's kind of adjusting the exchange rate when it's a fixed exchange rate. And they devalued it from 90,000 to 106,000. So this is going to be our beginning rate. And then the other one is going to be our ending rate. From 90,000 to 106. And so we can take these two beginning and ending rates and then put them into this formula. We started at 90,000. Lira was devalued to 106. And that, in percentage terms, is minus 15%.